Imagine standing in front of a roaring ocean. The waves crash, retreat, and rise again, completely indifferent to your hopes or fears. You might wish for calm seas or demand that the tide turn back, but the ocean doesn't listen. It moves on its own terms. The market is no different. Prices rise and fall with a rhythm and force beyond any single person's control. Whether we like it or not, the market is never wrong. What's often wrong are the opinions we form about where it should go. Jesse Livermore, one of the most legendary traders of the early 20th century, understood this better than most. He wasn't a man who studied finance at a university or climbed the corporate ladder on Wall Street. He started as a teenager, writing quotes on a chalkboard in a bucket shop, essentially the trading simulators of his era. From there, he trained his eye to read price movements, to see the rhythm of the market the way a sailor reads the tide. But here's the irony. Even with his gift, Livermore learned this lesson the hard way. He made and lost several fortunes over his lifetime, sometimes within just a few years. In 1907, he famously made millions shorting the market during a panic. In 1929, while others were ruined by the Great Crash, Livermore bet against the bubble and walked away with $100 million, roughly $2 billion today. And yet, despite these victories, he also experienced devastating collapses when he let his opinions or his emotions overpower the signals the market was showing him. That's why his words carry so much weight. Markets are never wrong. Opinions often are. They weren't born out of theory. They were carved from experience, from the painful reality of losing everything because he thought he knew better than the market. And the reason his story remains timeless is simple. Every new generation of traders repeats the same mistake. They cling to opinions, convinced their logic, their research, or their intuition can bend the market to their will. But the market doesn't bend. It simply moves. Take the dot-com bubble of the late 1990s. The Nasdaq soared more than 400% between 1995 and March 2000. Analysts, fund managers, and everyday investors convinced themselves that this time was different. Startups with no earnings, and sometimes not even meaningful revenues, were valued in the billions. Companies like Pets.com became household names not for their business models, but for their Super Bowl ads and catchy mascots. It felt like a gold rush, where the internet itself was thought to rewrite the laws of economics. But the market eventually delivered its verdict. By late 2002, the Nasdaq had lost nearly 80% of its peak value, wiping out trillions in wealth. The market wasn't wrong. It was investors' opinions, clouded by hype and blind optimism, that were. Fast forward to 2008. For years, banks, rating agencies, and investors believed U.S. housing prices could never fall nationwide. Mortgage-backed securities were stamped AAA, and Wall Street behaved as if risk had been engineered out of existence. Homeowners borrowed more, lenders relaxed standards, and the financial system built a fragile tower of debt on that single assumption: housing was unshakable. But when subprime loans started to default, the entire structure collapsed. Lehman Brothers went bankrupt, global credit froze, and stock markets plunged. It wasn't the market making a mistake. It was the collective illusion of stability that failed. The market simply revealed the truth faster and more brutally than most were willing to admit. And then came 2021, with the GameStop short squeeze. Retail traders on Reddit's Wall Street bets believed they could outsmart hedge funds, while some hedge funds were equally convinced the stock was destined to fall to zero. For a brief moment, the world watched as GameStop's price exploded from under $20 to nearly $500 in January. Millions of new traders opened accounts, memes flooded social media, and commentators debated whether this was a revolution against Wall Street or just a speculative mania. But when the dust settled, GameStop stock fell back closer to its fundamentals. Fortunes were made and lost in days.
Once again, the market wasn't wrong. It was opinions on both sides that swung too far. What ties all these episodes together is something deeper than charts, tickers, or interest rates. It's human psychology. Investors aren't just trading numbers on a screen. They're really battling themselves. Every buy and sell decision is filtered through emotions: fear, greed, hope, and regret. We crave certainty because uncertainty makes us deeply uncomfortable. Behavioral economists like Daniel Kahneman and Amos Tversky have shown through decades of research that people fear losses about twice as much as they value equivalent gains. That's why investors often hold on to losing trades far too long, hoping they'll bounce back, while selling their winners too quickly out of fear those gains might slip away. We also want to be right, because being wrong feels like failure. In markets, that desire to prove ourselves often turns into stubbornness. Traders double down on losing positions, convinced the market must eventually come around to their view. The irony is that markets don't reward ego, confidence, or even intelligence alone. They punish those traits when they harden into arrogance. The people who survive long-term are the ones who can do what feels most unnatural: cut losses quickly, admit mistakes, and move on without clinging to the need to be right. History shows that the people who survive and thrive are not the ones with flawless predictions, but the ones with discipline. Paul Tudor Jones, one of the most successful traders of the past half-century, once said his #1 rule is to play great defense. In other words, cut losses quickly, admit when you're wrong, and live to trade another day. That mindset, accepting mistakes and adapting, has kept him profitable for decades, even when his forecasts weren't perfect. Livermore's quote reminds us of a deeper truth. The market is a mirror reflecting collective reality at any given moment. Every tick on the screen is the outcome of countless decisions. Fear, hope, analysis, speculation, all compressed into a single price. You don't argue with it, you respect it. When prices rise, capital is flowing in for a reason. When they fall, something in the world is shifted. Your opinion doesn't change that tide. What it does change is your ability to survive it. The difference between being swept under and staying afloat comes down to humility, the willingness to accept that the market always has the final word. So, the next time you find yourself fighting the market, pause and remember, the market doesn't care about being fair, and it doesn't care about your opinion. It just is. The sooner you accept that, the closer you get to making rational, disciplined decisions, the kind that keep you in the game for the long run. If this message resonated with you, make sure to hit that like button. Subscribe for more stories that connect market history with timeless lessons, and share this with someone who needs to hear it today.